A very good morning, guys. Last episode, I told you the smart money had just bought volatility at the lows and that the calm was the trap. One session later, Nifty lost 24,000. It closed at 23,946, down 110 points. And the number that matters most isn't the price, it's the fear gauge. India VIX didn't fall on a day it usually does. It rose up nearly 4% to 13.56. Price down, volatility up on the eve of the biggest expiry of the half year. That is the market waking up. And today, the weekly, the monthly, the quarterly, and the long dated all settle into it at once. This is the Tanmay Edge. Today is Tuesday, 30th June. You are listening to episode 70. Let's go. So, what Monday actually did? So, Nifty 23,946 down 110 points, a little under half a percent. Sensex 76,728 down 372 points, and it was down as much as 480 points at the low. The index opened soft, leaned on to 24,000 all morning, and then lost it. The low printed at 23,925 and it couldn't climb back above the line into the close. And look under the headline, guys, because the internals were the worse than the numbers. Decliners beat advancers 2:1. 2036 stocks down against 1300 up. The mid cap lost a third of a percent. The small cap lost 6/10. This wasn't one heavy stock dragging a green tape. This was a broad-based selling that occurred. The leadership flipped too. Thursday, the autos carried the market. Monday, they led it down. Mahindra, Maruti, Tata Motors, Bajaj Auto all lower. Indigo with them. Kotak Bank was the single worst Nifty name, down almost 3% to 397. What held the line were the defensives. Max Healthcare, Dr. Reddy, the pharma names, Coal India, Power Grid, Bharat Electronics. When money rotates out of autos and banks and into pharma and power, the market is playing defensive. That's the tell you got yesterday. And the banks gave it up too. Bank Nifty lost 58,000, closing at 57,727, down 0.75%. Kotak alone fell more than 3%. The one pocket you'd hope you would hold the line didn't hold it. Hold that thought because Bank Nifty's monthly expiry also settles today. So, why it turned? So, what turned a quiet pre-expiry into a broad-based sell-off was the fuse I flagged last week, lit over the weekend. The US-Iran standoff flared again. Drones at the shipping in the Straits of Hormuz, strikes and the counter strikes, and then late both sides decided agreeing to a halt ahead of a peace talk this week. Crude bounced off its 4 month low, but the real pressure was closer to home. The rupee sat near a record low, 94.5 to the dollar. The weak rupee is what makes foreign money sell Indian equities. That's the macro that walked us under 24,000. And here's the irony, guys. You have to sit it with me. The rest of the world went up overnight. Wall Street rebounded extremely hard. The Nasdaq up more than 2%. As Washington and Tehran stepped back and a US court blocked a move against the Federal Reserve. India fell while the globe rallied. While you are the only one selling, the selling is local. And this morning we get the test straight away. GIFT Nifty is up 29 points and trading roughly around that 24,000 mark. The first question of the day is whether we take it back or no. So let's look at the flows as well. Now, who was moving the markets yesterday? The foreigners pressed the sell button again, out with 1350 crore in cash and another 1800 crore in the short index futures on top of that. The domestics caught it again in 2800 crore buying, a third straight session of the home team holding the floor. That's the whole tug of war in one line. Foreign money selling a weak rupee, domestic money buying the dip. Whoever blinks first decides whether 23,800 holds today or not. For the year, the foreigners are still out about 67,000 crore and the domestics have bought around 96,000 crore. That divergence is the market. Domestic money underneath, foreign money capping the top. The weak rupee just made the cap heavier. Now the options book, who is positioned for what, and here's that part that matters into an expiry. The index option positioning by participant pros and then foreigners, then client, and it shifted Monday in a way you need to hear. Last week, pros were long both wings, long calls and long puts, a pure wall bet that was happening. After 24,000 broke, they changed their stance. They slashed the long calls yesterday from over 1,14,000 contracts down to 23,000 contracts, and they kept the long puts still over 1 lakh contracts. Read that plainly, guys. The smart desk stopped betting on a bounce and held on to its protection. They are not playing for a snapback. They are playing for the move to keep going. The foreigners are leaning the same way, harder. Net short calls and net long, more than 6 lakh puts they added to the downside. So that is the play and that is what we are looking at. So let me move on. Let me move on and let's look at the positioning for clients as well. The crowd. The client is on the other side of all of it. Long futures, long calls, and net short more than 7,46,000 puts. A short that is going to bleed. Selling puts and selling puts in a bet that the market stays calm or climbs. So the board is split clean, guys. The informed desks are positioned for the move to continue and the crowd sold them the volatility. If today's settlement trends instead of pinning, it is the crowd short puts that are the fuel for it. Remember this. Now the levels and the volatility math. Now today's lines, and this is the heaviest expiry on the calendar. The Nifty weekly, the Nifty monthly, Bank Nifty monthly expiry, as well as June, which is a quarterly and comes in the leaps as well. The most open interest of the half yearly unwinds at once. So the positioning has maximum pull on the close. The pin on paper is 24,000. That is the max pin where the expiry should happen. And today is also the biggest resistance at 24,000. Traders wrote more than 8.5 million calls at 24,000 and nearly 8 million more at 24,100. So the level that was the support yesterday is the resistance today. The floor you lost becomes the resistance you have to win back. Below us, the next real support is 23,800, where fresh puts went up, and under that an air pocket towards that 23,650 mark is present. And the volatility, because it changes how you read those lines. India VIX at 13.56 and rising, still cheap in absolute terms but no longer falling. The ATM straddle for today's expiry is pricing a move of roughly 160 points. Remember this in this session. So call it 23,780 on the bottom end to 24,110. Here's the trap, the pin. 24,000, the magnet only pulls hard when the volatility is falling into expiry. When volatility is rising into expiry, like right now, price detaches from the magnet and the day can trend instead of pinning. The mechanical bounce back to 24,000 is real, but it is not a safe bet the textbook says it is. Now, some educational part, guys. Write this one down because it is the opposite of what you have been taught. The standard expiry playbook says volatility gets crushed, sell the straddle, and the index pins to max pain. That works on a normal expiry when the fear gauge is bleeding lower into the close. But flip that one variable. When the fear gauge is rising into the expiry, the whole playbook inverts. A rising VIX means the option sellers are getting hurt, not paid. It means the magnet at max pain loses its grip because the people whose job is to pull price to the pin, the writers, are the ones who are going to bleed today. And on a max settlement day like today, with weekly, monthly, quarterly, and long dated contracts all expiring at once, the moment a key level breaks, the hedging across all the moves accelerates in the same direction. And that's how a quiet pin day becomes a 250 point trend day. So the tell isn't where the max pain sits, it's which way volatility is moving as you walk into the settlement. Falling volatility, trust the pin. Sell the premium. Rising volatility, respect the trend and look for mean reversions. Monday, vol rose. Today, I am not trusting the pin and could expect a mean reversion as well. So the plan is simple, guys. So here's how I am playing it, and the bias hasn't changed. Buy the dips, but you buy the dip at the support that's still standing, not the one that just broke. 24,000 broke on the close, so we are opening near the resistance now. So not the buy zone. The dip I want is 23,800. That's the real support, and that's where I'll buy with a stop on a closing break below it. Lose 23,800 on a closing basis, and the air pocket opens towards that 23,650 mark. So 23,800 if we are buying, the stop loss is just 20-25 points lower, and that gives a cushion. And the long put skips paying. On the upside, reclaim 24,000 on a closing basis and the magnet wanes. The bounce is real, and then we head back again towards that 24,200 mark, and the crowd shorts puts get their relief. But the structure of the trade is the optionality. Volatility is cheap and it is rising into the half yearly biggest expiry. So I would rather own a cheap option than sell into one. If the range breaks, the move is worth multiples of what the option costs today. That's the whole lesson of the last two sessions, guys. The pro bought volatility at the lows. Monday it started to pay, and then they cut their upside and kept the hedge. Today the biggest expiry of the half yearly settles into a rising fear gauge. Buy your dip at 23,800, own the optionality, and let the expiry come to you. 24,000 is resistance now. 23,800 is the support. Volatility is rising into max settlement expiry. So don't trust the pin, respect the move. Either way, you will see it before the chart does. That's the tape behind the chart you just got earlier, guys. So that's your edge for today. If this added value, share it with one trader friend who needs it right now. Subscribe on Apple Podcasts, Spotify, or stream live on rupeecase.com. I am building RupeeCase, India's first systematic investing terminal. Link is present in the show notes, guys. You just got earlier. See you all once again tomorrow. Have a very happy expiry.